Malcolm, great pleasure. Topic today is how Brexit will impact the Chinese economy. And when Brexit, first happened, you saw worldwide stock markets drop quite significantly. But was interesting, China, the first day of trading after Brexit, the market dropped 1%. Second day, it bounced back 1%. So you could say in China, there was a pretty muted reaction, whereas elsewhere around the world, there was quite a bit of financial panic. So I think the calm reaction in China reflected the three topics that we're going to talk about today. First, Brexit has little direct effect on the Chinese economy. Second, it does increase the risk of financial volatility, probably not a lot, but if there's anything to be concerned about, is it does increase the risk that there might be some exchange rate or other volatility in the Chinese financial sector. And then frankly, in the long run, it's hard not to see this as anything but a plus for China. This is quite a significant blow to the West, and it just plays into the whole narrative of the decline of the West and the continuing rise of China. So let's take the first topic, that there's little direct effect from the Brexit on the Chinese economy. Now, it is true that the European Union as a whole is China's largest trading partner, right? So if you look back over time, certainly China's exports to the EU, including the United Kingdom, have been significant. The exports directly to the United Kingdom are not that important, but the EU is the largest trading partner. I think if this had happened 10 years ago, there would have been a lot more concern when we were in the heyday of China's export-oriented growth. But really, the important development in the last few years in China is that exports have become much less important to the economy. The Chinese economy is growing primarily on the basis of its domestic consumption. I like this figure a lot. This is the 4-quarter moving average of the contributions of investment and consumption to GDP growth. We'll bring in net exports in a moment, but this is just focusing on the investment and the consumption. China's, aside from being export-oriented, pretty heavily investment-oriented growth model, and that's related partly to the exports. A lot of that investment was building up the export capacity. But what you see, this is since 2010, just a very clear tendency for investment to slow down continually. So now it's contributing just a little bit more than 2 percentage points to Chinese GDP growth. Consumption, meanwhile, is really quite stable. A little bit of a downward trend for a while, but the most recent trend is upward. So China's getting most of its growth from consumption. It's got a nice virtuous circle going where the labor market is relatively tight. Wages are going up, consumption is rising. Consumption is mostly services. They're more labor intensive, so that's keeping the labor market tight. So really the key challenge for China is not exports, which are a lagging sector nowadays. The key challenge is to keep up that positive dynamic in consumption. Now, if we bring in exports, that's the green part. I didn't put it in the other figure just because it's been so close to zero for years. The contribution of net exports slightly positive in 2013, but mostly negative and frankly very small. So on average, it's really right around zero. So what that brings us to is that China is just not very dependent on net exports anymore. We just got some more disappointing trade data in the last 24 hours, by the way. Their June exports were down slightly. The June imports were down. I think this is all consistent with the fact that trade is not that important for China's GDP growth. So we have to admit Brexit is a modest negative, certainly for Europe's GDP growth. You'd expect that to have some effect on China. So China's trade is likely to grow less rapidly. But that's just not that important for the Chinese economy. As I said, the key thing to watch there is not related to Brexit. It's really, can China keep up that positive consumption dynamic? We'll get the GDP data within 24 hours. Probably it's going to be GDP growth of about 6.6%, which is solid, and it's relying very much on China's consumption. So then that takes us to the second topic, this risk of increased financial volatility. The key challenge here is that China has been trying to stabilize its exchange rate with respect to a basket of currencies. This is an important announcement they've made over the past year. After a long period of managing against the dollar, they really want to manage their currency against a basket. They've formally announced a basket which more or less reflects their trade weights. The Bank for International Settlements also calculates a trade-weighted exchange rate for China, slightly different than the official basket, but similar and available on a more reliable basis. So I'll talk a little bit about that. But first, let's look at the Chinese exchange rate against the dollar. This is what people are used to thinking about. It starts, for a long time, China was pegged to the dollar at 8.3. That came to an end in 2005. So this figure starts with the end of that peg. And you can see that until quite recently, pretty steady trend. This was appreciation. When that price goes down, that's basically the price of a dollar. So when that price goes down, that means the Chinese currency is appreciating against the dollar. There was a long period of stability noticed at about 6.8 during the real heart of the global financial crisis. But basically, there's been a pretty steady trend toward appreciation against the dollar. And through a lot of that period, the dollar was mildly depreciating against other currencies. And what really changes about a year ago is you start to get sharp appreciation of the US dollar. And that's when the Chinese changed their strategy. They really did not want to be in the situation of having to follow the dollar up if the dollar was going to keep rising. So that was that dramatic event last summer, which you see there, where suddenly they devalue their currency, announce they're going to manage against the basket. And there's been some, with a little bit of volatility, but there's been some further devaluation against the dollar over the last year. That's really created a lot of nervousness. Now, I think the background to this is really, the best way to think about the background is to look at these real effective exchange rates. This is the Bank for International Settlements calculation of trade-weighted exchange rates for China and the US. And the real means that in each case, you're taking account of inflation differentials. Focus first on China, the blue line. So since ending that rigid peg to the dollar in 2005, there's a long period of pretty gradual appreciation of the Chinese currency. And I think that's appropriate, for a developing country with fast productivity growth. Throughout most of that period, China had a large current account surplus, and so it was appropriate for the currency to be appreciated. And then if you focus on sorry, Malcolm, just let me say a word about the dollar. If you look at that red line for a moment, the long-term trend has been very modest depreciation of the dollar until you get to 2014. And then you see that the red line starts a pretty sharp and steady appreciation. And initially, China follows that, but you can see that this really takes them on a new trend toward a much steeper path of appreciation. And that's what caused China to change its exchange rate policy, is if the dollar is going to be rising against most of the world, China does not want to follow the dollar up. It does not want such an extreme amount of what we call effective appreciation, of trade weight appreciation. So that's really why they shifted off the managing from the dollar. Now, they're in a difficult situation because they still have a large trade surplus. And in fact, you can see here, they've had a large trade surplus throughout most of this period. It came down a bit during the global financial crisis and after, and I think exchange rate appreciation played some role. But notice the most recent trend is for that trade surplus to rise a lot and hit a historic high last year. And Chinese are very conscious of this. and China's main trading partners are very conscious of this. So this, you'll see a lot of talk about the need for the Chinese currency to devalue, but China's partners are looking at this and saying that this is a country with a very large trade surplus, and so the partners certainly do not want to see any devaluation. And if they have this large trade surplus, then you might ask, well, why is there any pressure in the currency market for depreciation? And the answer is there are capital flows that are actually larger than that trade surplus, net capital outflows. Malcolm's found us a really nice picture to capture the net capital outflows. So there you've got some capital flight, large bundles of Chinese currency taking a plane, leaving the country. But I think more seriously, you've got large net capital outflows, and to try to link the different parts of this analysis, if you think back to that long slowdown in investment in China, so that's saying there are fewer and fewer investment opportunities. There's a lot of excess capacity, but there's still a lot of savings in China, right? So more and more of that savings is going out to the rest of the world. A lot of it's coming to the United States, frankly. My book on Africa, that's talking about Chinese outflows, capital flows to Africa. So they're trying to manage a very difficult situation, large trade surplus, but also large capital outflows. If they balance, then that's consistent with their hope to keep the exchange rate stable. But if the capital outflows get out ahead of that trade surplus, then that creates depreciation pressure. And so that really brings us to why Brexit does create some problems for China. Is certainly one of the important things we've seen from Brexit, now that we've had nearly a month to absorb it, is we've seen some very serious currency moves among the other major currencies in the world beyond the Chinese yuan. Most obviously, the pound is depreciated quite significantly. The euro's depreciated a bit, and many market participants expect the euro to continue to depreciate. So this is one of the effects of Brexit, is that growth prospects are less good for Europe and the UK, and those currencies have declined quite significantly. Meanwhile, the dollar has risen, the yen, against the will of the Japanese authorities, the yen has strengthened quite a bit. My colleague Ben Bernanke's over there in Japan this week talking to them about helicopter money, which might have the effect of pushing the yen back down. But the main problem is this creates a problem for China, this volatility among these different currencies. In past global crises, Asian crisis or global financial crisis, China has been a source of stability. But frankly, they're now reluctant to really tie themselves to the dollar because they don't want they've accepted that exports are not going to play the same role as in the past, but they don't want to see too much further appreciation of their currency. So they would really like to have stability against the basket. That becomes a little bit harder when the other currencies in the basket are moving around a lot. And it's a difficult thing to explain to ordinary people. If ordinary people see that exchange rate against the dollar constantly depreciating, and the authorities are telling them, well, this is stable because we're stable against the basket, that's a little bit abstract. So they're fighting this problem that if people keep seeing the currency depreciate against the dollar, they may very well think that that's going to be an ongoing tendency, and there's always a risk of a kind of speculative attack on their currency that people will be trying to get out ahead. I think the Chinese authorities will probably succeed in keeping their currency pretty stable against the basket, but this is definitely one of the risk scenarios. And then that brings us to the last topic. Really hard not to see this as a geopolitical plus for China. This Brexit decision is going to be keeping the European Union somewhat distracted. Certainly, it's going to take a prolonged negotiation to figure out exactly what Britain's relationship is going to be. So I think and then of course, from the point of view of the remaining EU members, they have to worry about other big economies such as Italy, or even small economies such as Greece, leaving, and for them, it's not just leaving the European Union, it would also be leaving the euro currency. So I think Europe's got a lot of serious problems it's got to deal with. Britain, this is going to be a real, I don't think there's anything good in this for Britain, to tell you the truth. So they're going to be absorbed with this. And the U.S. is going to have to pay a fair amount of attention to trying to make this work out as well as possible. While it's hard to see Brexit as having a big direct effect on the Chinese economy, as I argued, I definitely think it's going to have some indirect effect. This plays into China's hands in a number of ways. An important issue on the table right at the moment is that China wants to be recognized as a market economy. It's symbolic to them. It's also practical because that affects how anti-dumping cases are adjudicated. Just in the last couple of days, there's been some positive noise from Europe about moving ahead with that. I think you think about Brexit as creating a shock for both England and for the remaining countries in the EU. It's more important for them now to try to develop good relations with China, so they're more likely to grant China market economy status. The US would like to resist this, but if the UK and the EU move ahead with it, then it's very hard for the US not to also provide market economy status. So I think that's just one concrete example of how China might very well benefit. Another good example is China's negotiating investment treaties with all these different partners. So it's going to be much easier for them to play divide and conquer in trying to get a favorable investment treaty. Now, the UK has been kind of a favored partner of China. There's been a lot of, if you look at where Chinese investment goes, top two destinations are the United States and the United Kingdom up until now. That is likely to change, in that the UK will be less attractive, but on the other hand, UK will now be under pressure to make favorable deals with China in order to build up that relationship, since their relationship with the remaining EU countries is almost certainly going to diminish to some extent. So I think that Brexit may not be that important directly, but in many ways it's a signal of the decline of Europe and the rise of China. So in wrapping up, I don't see Brexit as having much direct effect on the Chinese economy. They have a lot of challenges, and in the Q&A, we certainly can get into any of the challenges facing the Chinese domestic economy with growing debt. And they have, as I said, the challenge of maintaining this healthy growth of consumption. They certainly have a lot of challenges, but I really don't think there is much prospects for their exports to grow very rapidly. So I see this as reinforcing a trend that was already there, and it's not really a bad thing for China. They need to get away from the export dependence, really focus on making their economy more domestically demand-driven, more consumption-driven. So I think Brexit just strengthens a trend that was already occurring. It does increase the risk of financial volatility. I think in general, Brexit's it's just evidently unleashed a lot of financial volatility, because we saw large drops in stock markets, and then some of them have come back. New York has obviously come back and hit a new high. European markets are more subdued. Currencies have moved a lot, and there's an expectation that could continue. So just in general, Brexit's created financial volatility, which is a problem for the world. And I think it's a particular problem for the Chinese, because they really would like to have a stable exchange rate, but their tradition of stabilizing against the dollar, slow appreciation against the dollar, that strategy just doesn't really work in this environment. It creates the potential that they would have very large effective appreciation, and they've had enough effective appreciation. They don't want a lot more. The technical desire for them to manage this is very clear, but people's expectations complicate things. So the worst thing for them would be is if the Fed moves ahead relatively quickly with interest rate increases. If you get further appreciation of the dollar, then what that means is for China to stabilize, they're going to be depreciating against the dollar. And as that becomes larger and more visible, there is a risk that that'll catalyze destabilizing capital outflows. So they've got a big challenge managing their capital outflows, trying to keep their currency under control. I do think, by the way, that a unruly devaluation of the Chinese currency would be a very bad scenario for the world. First, it's something the Chinese leaders definitely do not want, so it would be a sign of their impotence if that happens. And then, as I emphasize, they've got a very large trade surplus, so it might seem to provide a little bit of stimulus to their economy, but I think it'll be quite a disruptive event for the whole world. You might have enough downside effect on global growth that it all just backfires on the Chinese. So Chinese leaders are not thinking that devaluation is going to stimulate their economy, and any large devaluation is going to stimulate their economy. That's why they try to avoid it, and maybe a little bit of devaluation against the dollar. Obviously, they've had that, so if they can do that in a stable way, that's fine. I think we'll look back and see this as an important moment that really kind of crystallizes that globalization has created a lot of problems for the advanced industrial countries. To be frank, I think that Donald Trump's candidacy is a similar phenomenon, something similar to Brexit, reflecting dissatisfaction with how globalization is playing out for advanced economies like the UK, like the United States. Meanwhile, China continues to rise. They have a lot of challenges, and so various things could go wrong there. But I don't think it's Brexit that's going to create any big problem for them. I think it's their internal difficulties that are more likely to create problems for them. So, conclusion, keep calm, don't panic. Don't panic about Brexit's impact on China. Plenty of things to worry about in the world and plenty of worry about in Europe, but I think Brexit's effect on China, not likely to be one of our big problems.
We had a number of questions that came in before we started. Most of them are concerning the RMB. The first is London likely to maintain its role in the internationalization of the RMB?
So it's hard to really predict these things, but my instinct is that London is now going to decline as a global financial center, and it seems unlikely that London would really maintain a role as a key RMB trading location. First of all, New York is finally getting into the picture, after some resistance from the U.S. government. So New York will be getting involved. So if you think about the likelihood that other currency centers around the world will be doing more with the RMB, that was going to happen anyway, regardless of Brexit. Then you add in Brexit and the fact that the European financial center will probably, shift away from London, and I would expect that will affect London's role with the RMB.
Another question, how will Brexit affect the RMB euro exchange rate more directly?
I think, we've already seen some depreciation of the euro vis-a-vis the Chinese yuan, and to be frank, I would expect that to continue. It's notoriously hard to predict exchange rates, but the market expectation is that the euro will decline further over the next year. If the Chinese can succeed in their stated objective of being stable against the basket, that means they'll be appreciating against the euro, probably not dramatic unless the fall of the euro is dramatic.
Another question is, will strain on the euro enhance or harm the RMB as a potential reserve currency?
Oh, I think all of this, I wish I'd put that in the presentation, Malcolm. I think that's another way to think about the kind of effect of Brexit on, as a geostrategic gain for China. They voted to include the Chinese currency in the IMF special drawing right. So that'll be implemented, I think, in the last quarter of this year. So the special drawing right is now going to have 5 currencies: the dollar, the yen, the pound, the euro, and the yuan. Now, as they did the analysis, not only did the Chinese currency meet the standards that would get it included, but it was interesting that the British pound was already on the borderline. So I think we can now be confident the British pound will be dropped from the SDR. And frankly, it's possible within a short time that that the euro might be dropped as well. So I think we are moving to a world where the dollar and yuan will be the primary reserve currencies. It'll take a while for the Chinese currency to get there, but that's the trajectory. And this Brexit and this larger questions about Europe and the euro, all of that just plays into China's hands.
Another on the currency more generally, will or has the PBOC adjusted the basket? Overall, should it be good to China's capital outflow pressure? And what about the banks, corporates, and investments in London? How will they change their strategies? So sort of a double question. What about the basket, and what about the impact of London more generally as how people, other firms will look, Chinese firms will look at it?
Right. So they have not changed their basket. They defined the basket, and they publish their exchange rate against the basket on a regular basis. They've confused people a little because, while they've said they want to be stable against the basket, I think they may have created a little problem for themselves by setting the base of the basket at the end of 2014 when their currency was really quite high. So they've actually depreciated, I think, against the basket about 5% from that base period. So that, you can argue, stability doesn't mean perfect stability. So you can argue or question whether 5% meets stability. But I think they complicated their life a little bit in the sense that their currency is stable against that basket if you go back a little bit further in time, but it is down about 5% since the base period, end of 2014. But they're not going to change the weights in the basket. I think that would just create additional confusion.
And now, go ahead.
Second question, I think the UK had been their favorite destination in Europe. It just seems inevitable that's going to change. Most economists, including myself, we're expecting UK to go into recession because there's going to be so much uncertainty that it's just hard to see how you're going to get investment in that environment. That's true in general. And then the Chinese are likely to be similar. No reason for the Chinese to be different. They might go in there looking for some bargains, given how the pound has declined. But since they were thinking of UK as a jumping off place to the rest of Europe, that's really diminished now. We don't know if the UK is a jumping off place to the rest of Europe. The UK's really created a problem for itself because they think they might be able to negotiate some kind of free trade agreement with the EU, but the EU has required countries like Norway to have free immigration of EU workers in order to have that, and that was the big issue in the whole Brexit campaign. So it's really hard to see how UK is going to turn this to their advantage.
Well, let me take you to another question we got earlier from our participants, and that is a post-Brexit EU going to create, as perhaps EU unravels, becomes weaker, create different opportunities for China in Europe?
So my instinct is that China is best served, if there's some kind of continuing instability and problems in Europe, but they don't accelerate into real disintegration. Extreme scenario, example, had to leave the euro and the EU in order to manage its fiscal situation. I think that's a big disruption. That's likely to affect the whole world economy. And I emphasize China's not as export dependent as in the past. But if the whole world economy goes into recession, it's hard to see how that doesn't have an effect on China. So I think the more dire scenarios are not, definitely not in China's interest. On the other hand, I think, Europe continuing to limp along a bit. China's not relying on their demand very much. So that creates some opportunities for China on some of its strategic ambitions, creates some opportunities to go looking for bargains in different European countries. China was one of the countries going into Greece, for example, and buying some bargains. So my instinct is that Europe limping along a bit, but not dragging down the whole world economy, works well for China. One just popped up on my screen.
Yes, go ahead.
It disappeared quickly, but I'm pretty sure it was about, whether I have figures on Chinese ODI to UK versus the rest of Europe. Yeah, I don't have it sitting right in front of me. I know UK is the largest destination within Europe for Chinese overseas investment. Pretty sure Germany, France, also fairly significant.
How will the perception of Chinese high net worth individuals and other ultra high net worth individuals be toward UK assets, real estate in particular, and toward because of Brexit?
Yeah, so I think, I emphasize that the UK overall, probably less attractive destination for Chinese investment to the extent that they're thinking of it as a jumping off place for Europe. That would be particularly relevant for manufacturers and distributors. But on the other hand, if you're thinking about buying British property, partly because you want to have a kind of a safe haven for you and your family, my instinct is that UK becomes more attractive in a sense because everything just got cheaper. It's probably going to be 40% cheaper to buy an apartment in London, and there are a lot of connections, positive connections between China and the UK. A lot of Chinese sending their children to first to high school, private high schools in the UK, and then to college. All of that just got a lot cheaper for Chinese people. So that's a really good question. That aspect of investment, I could very well see rising because it's not like the UK is going to disintegrate. Scotland and Northern Ireland may leave, but from the point of view of a Chinese high wealth person, London is probably still going to be an attractive place. Sending your kids to school there is still attractive. So that's probably going to increase. See one popped up on my screen, whether Brexit affects the Trans-Pacific Partnership. Good question. Obviously, Trans-Pacific Partnership has become something of an issue in the U.S. election. Donald Trump is very negative about that and any trade agreement. Hillary Clinton has distanced herself from the Trans-Pacific Partnership compared to when she was Secretary of State. I think most of us analysts feel that Clinton presidency, it's not going to be a slam dunk to get TPP through, but under a Clinton presidency, there's a good chance, either that she would quietly allow that to go through in a lame duck session at the end of this year, or with a modest amount of renegotiation, it might go through. Certainly, it's got better prospects under a Clinton presidency. So an interesting issue is this Brexit. It's a similar kind of phenomenon as Trump, but I'm not sure it plays to Trump's advantage, frankly. I think within a couple months, we're going to see even more negative results on the UK economy, maybe very well, evidence that they're in recession by the time we get to our election. So the whole notion of trashing trade and immigration deals, that maybe the luster may be off that a bit. So I wouldn't be surprised if Brexit affected the U.S. election a little bit more in a pro-globalization direction.
Let me move on to the big general question here, David. Is Brexit the beginning of the end of globalization? Donald Trump is the U.S. version of Brexit. Do you think Americans are learning lessons from the political consequences and hence will be more rational and practical in the coming months in presidential election? You just touched on that, but I thought you might want to go on to the end of globalization.
Yeah, no, I think, I'm an optimist, so I would like to think that this is not the end of globalization, that this is the beginning of fine-tuning our policies so that more people benefit from globalization. For example, I thought it was very interesting, Larry Summers' most recent column in the Financial Times, and I think it's fair to describe him as a pretty gung-ho pro-globalization guy. The tone of it, that column was that, we really have to look at measures that make sure our people are benefiting, Americans from his point of view, that, each country is going to have to take a hard look to make sure that its people are really benefiting the broad mass of people. And that's, to me, fine-tuning globalization is the way to get there. I'm pretty sure if we start pulling out of agreements like NAFTA and trashing some of these trade agreements, I'm confident that's going to be very bad for American workers. That's not going to be a solution. But so the question in the U.S. is, can we get bipartisan support on some sensible measures? So just an obvious one, we need to spend more money on infrastructure. And if we could just get bipartisan agreement on how to move ahead on that, that's going to increase the productivity of our economy. It's going to put some people to work, create some blue-collar jobs. So I think there are things we can do, but that's going to be the really interesting question for social scientists over the next 10 years or so. Is globalization starting to unravel, or are we finding ways to enhance the benefits from it?
And what do you think Brexit, you think Americans are paying enough attention to Brexit that it's going to have any impact on political discourse in this election cycle?
Well, apologies to British friends, but I think you've done us a favor. I think this is all going to work out very, very badly for the United Kingdom. I wouldn't be surprised if Scotland and Northern Ireland left. So the rump England is going to be a pretty minor player in the world, and they're going to take a big hit in their per capita GDP, and it's just. But I think they've done us a favor, because I think already it's got visible negative effects on the UK, and I think by the time of our election in November, I think those effects are going to be cleared. So I do think this is a bit of a warning thing. I've got 2 kids in their 20s, and what I say to them is, you've got to be talking to all your friends about the importance of voting, because what's happened, a lot of young British people have suddenly discovered that their lives are circumscribed. They didn't show up to vote, and now, a bunch of angry old people have basically totally changed their opportunities. I mean, it's really dramatic. It's a great example of voting really matters.
Thank you, David. That was terrific. And now, book. David just came out yesterday with China's engagement with Africa. Just go to Brookings, look for David, and you will find it there. David, could you give us just a couple of minutes about what your new book's about?
Well, there's been a lot of controversy about China's engagement with Africa. I mean, it's been one of the big factors in Africa in the last 15 years. But frankly, China's engagement is largely positive. They provided demand for African exports. They're providing quite a bit of direct investment, and they're financing infrastructure. I think a couple of the main things, a lot of that's of significant scale. You sometimes get the impression that China is overwhelming Africa, but in fact, just take one example in infrastructure. For all the foreign financing going to Africa, China's providing 1/6. So that's the kind of number that's significant enough to be helpful, but it's not the case that all of this infrastructure in Africa is financed by China. World Bank is still big there, African Development Bank. Actually, private investment in infrastructure in Africa has really taken off. So I think overall, China provides quite a bit of positive incentive for Africa. But initially, a lot of that was focused on natural resources. And what I'm trying to emphasize, the subtitle of the book is From Natural Resources to Human Resources, because that, as the Chinese growth model changes in the way we just discussed, Malcolm, China's appetite for natural resources is declining. On the other hand, as I emphasized, a lot of Chinese investment is going out. Some of that's going to Africa, and not just in natural resources, it's in services and manufacturing. That's a very positive development that should be encouraged.